Markets don't usually break all at once. They crack quietly at the edges, in places most investors aren't watching. And right now, that crack isn't coming from Silicon Valley, Wall Street, or Washington. It's coming from Tokyo. Bitcoin is sliding. Risk assets are rolling over. Yields are rising when they shouldn't. And beneath the surface, something far more structural is unfolding. What looks like short-term volatility is actually the market reacting to stress in the global monetary plumbing. Stress that's been building for decades and is now finally surfacing. In the latest episode of his weekly podcast, Jack Mallers, CEO of Strike and one of the sharpest macro thinkers in Bitcoin, walks through why Japan's bond market has become the single most important story in global finance today. Japan has long been the foundation of cheap global money, propping up risk assets across the world through zero and negative interest rates. But that era is breaking. As Japan's bond market destabilizes, the effects are cascading outward into U.S. bonds, U.S. equities, and ultimately into Bitcoin and crypto. According to Jack, this isn't just a market drawdown. It's a warning shot that the current fiat system is being pushed to its limits, and the consequences may be far larger than most investors are prepared for. In this video, Jack breaks down what's happening in Japan, why the U.S. is watching the yen so closely, how this stress transmits through global markets, and what it ultimately means for Bitcoin's role in the next monetary regime. If you value clear, honest macro analysis from people who actually understand the system, make sure to like the video, subscribe to the channel, and watch all the way through. This is one you don't want to miss.
So Bitcoin obviously continues its slide. This feels like a bear market. It feels like we're in the depth of sorrow and pain. Risk markets also started to slide as Trump announced his new Fed chair nominee in Warren. And for this episode, what I really wanted to do, listen, this is a show by the common man for the common man. If you want really complex macro, if you want a PhD in macroeconomics, you're not necessarily going to get it on this show. This show is about truth, transparency, and education for the people. And so what I thought we would do today is break down some of these fundamental concepts, really pull on the thread. You've probably heard yields are rising, the bond market is in trouble, Bitcoin is sliding, risk off. What the hell does all of that mean? How does it tie all together? What's going on? What events are leading to Bitcoin selling off? And then what could it mean for Bitcoin in the future? Obviously, we don't know the future, but what could it mean for its future? Let's move on. The first section of today is titled Japan, the biggest story in finance. Why something happening in Tokyo shows up in your portfolio. So it's true. This section speaks for itself. The biggest story in macroeconomics right now is Japan. I move on to the next slide. You see this article from Bloomberg. Japan in close contact with the United States on the yen as needed, FX chief says. Next article, Japan's bond market has a warning for America. Sounds intense. Next article, Apollo says risk of yen carry unwind as speculators cut their bets. Apollo Management's Torsten Slok said there's a risk of the yen carry trade unwinding, citing recent sharp moves in speculative futures positioning. Speculative futures positioning has swung sharply, highlighting that carry trades can unwind quickly even as the broader yen-funded footprint remains in place. Okay, these are all recent articles from Bloomberg with a focus on Japan. What's happening in Japan is the most important thing going on in markets. It is the most important thing going on in macroeconomics. And we need to understand it if we want to understand why prices are doing what they are and arguably why Bitcoin is doing what it is. Now let's take a look at Japan. This section is titled Japan, the straw that's breaking the United States, examining what's really going on in Tokyo. So first you guys need to understand something kind of foundational to global markets. Japan is known as the foundation of cheap global money. The reason for that is they have had persisted rates at zero or sometimes negative for a very, very, very long time, okay? So you could borrow money for free, or sometimes you could have borrowed money and gotten paid for it, which is insane. It is an insane concept that human beings were being asked to get up and go to work and contribute their time, their energy, their effort, and their labor, and be compensated in something that other people were able to borrow for free. That doesn't make any sense, okay? We're going to ignore the absolutely criminal, malicious, and illogical function of fiat money and just understand that for this very reason, that you can get access to lots of money cheaply, Japan became the foundation of cheap global money. And for that reason, they're now facing inflation because there's been so much monetary creation and stimulus in Japan where the people are starting to face inflation that's crushing them and that they can't stand anymore. Okay? Now, this is the shot heard around the world. It's the rate check. So this slide is titled Rate Check ... Is this thing on? The Wall Street Journal article that I have screenshotted here reads, Treasury rate check boosts the yen and weakens the dollar. US and Japanese authorities are increasingly worried about the yen and could be signaling intervention around the corner. And my subtitle is, why is the US watching the yen? It's a good question. I live in Chicago. I'm American. Why does my country care about what's happening in Tokyo? Why does the United States care about the yen? Well, quickly, just for definition purposes, a rate check is when the government, so the US Treasury specifically, I'm talking about Scotty Besson in particular, he calls his major banks. In this instance, he called the New York Fed, and he asked about currency levels. What he effectively asked for and hit the press wire is, if I wanted to buy a bunch of yen to protect it from continuing to fall, what price would I get for my dollars? And it was the shot heard around the world because what he's saying is, this is very close to a crisis and I might need to bail Japan out. And a rate check is the technical financial term to tell the market that that's what's going on, okay? Now, why does the US care about the yen? I live in Chicago. I don't necessarily care what's going on in Tokyo. Not to be I'm not saying I don't care about everybody. I hope everything's well in Tokyo. But why is my country in particular worried about the yen? Well, now that we understand bonds, yields, and currencies and how they're directionally traded based on confidence and an ability to pay back what is ultimately a loan, let's look at this. What you guys are looking at is in blue, you're looking at the US 10-year over the Japanese 10-year. And in red, you're looking at USD over JPY. What am I talking about? Guys, they're not supposed to be running in opposite directions. Remember, this is the whole point. If yields go up and the market is confident in you and your country and your debt situation, then capital will rush in. It'll strengthen the currency and you will have confidence in your bond market. If the opposite is true and yields go up, but the yen starts crashing, that's not good. Okay? This is bad. This smells trouble. And so what I have at the bottom is when developed markets start acting like emergent markets, the streets smell blood. This is behavior that's typical in an emerging market like Argentina, not Japan. This is really bad. Now, why is the market acting like this? Well, for those of you guys that don't know, Japan has the highest debt to GDP in the world. Again, it is a very unique market. Its debt to GDP is 250%. Now, there's some nuance as to why that is. It shouldn't be directly compared to the US because the Bank of Japan actually owns a lot of its debt and they also own a lot of assets, okay? So we go on, but here's what I need you guys to fundamentally understand. For what I'm calling a normal country that I have in green here on the left, when interest rates go up, money flows in, the currency gets stronger. That means investors trust it, okay? On the right, in red, is what I call a fragile country on this slide. When interest rates go up and investors get scared and the currency gets weaker, that means the market is saying, oh God, they can't actually pay this back. And why Japan is the largest story in macro right now and the largest story in finance, period, is because they are the third largest economy in the world and they're trading like a fragile country. These are the signs and the signals that we are approaching the end of the fiat regime as we know it.
As Jack explains, what we're witnessing in Japan isn't a localized issue, it's a signal. When a developed economy begins trading like an emerging market, confidence is breaking down. Rising yields paired with a weakening currency are not normal behavior for a country like Japan. They're symptoms of a deeper problem: too much debt, too much monetary intervention, and diminishing belief in the system's ability to sustain itself. This is why Jack frames the situation not as the immediate collapse of the dollar or the overnight replacement of fiat, but as a monetary regime change. The old playbook is no longer working, and the market is starting to call the bluff. Japan is effectively trapped. If rates rise, the cost of servicing its massive debt explodes, banks take losses, and the system risks a severe depression-level event. If the Bank of Japan intervenes through yield curve control, printing money to cap yields, the result is extreme inflation, a collapsing yen, and the erosion of national credibility. There is no painless path forward. As Jack outlines, these are binary outcomes. Either debt is resolved through inflation and currency debasement, or it collapses through austerity and systemic failure. And because Japan sits at the center of global capital flows, whichever path it takes won't stay contained. It will ripple outward, straight into U.S. markets and risk assets worldwide.
But still, what does this have to do with the United States? Why is Scott Bessent issuing rate checks and ready to bail out another country? I thought it was America first. I thought it was MAGA. Whatever idioms you believe in. What's going on? Well, here's what's going on. Japan owns everyone else's stuff, okay? What this image shows is that Japan has about $5 trillion of overseas holdings, okay? Now, again, we've talked about this on the show, but just to reiterate, the reason for this is when the United States is the world reserve currency, they have to run a deficit, a twin deficit, to be clear, meaning they export dollars to everyone else and import everyone else's stuff. And so the United States exports more fiat than they bring in, okay? Now, what does everyone do with the fiat that they get? China, Japan, like everybody. Well, they buy assets. And again, I'm oversimplifying, not by a lot, but bear with me here. So Japan, everyone, to be clear, owns a lot of U.S. assets because the way the flow of funds works is the United States prints the dollars, they export them all over the world. The world uses those dollars to buy things. It's like going shopping in the dollar store. What can I buy with these dollars? Well, you can buy U.S. stocks, you can buy land, you can buy U.S. treasuries. And what people have bought is a lot of U.S. assets over time. Since the dollar has been the world reserve currency for a long time and it severed itself from gold in 1971, we've printed a lot of money, and all of that gets reinvested primarily back into the U.S. assets. This, guys, is what leads to traditionally an artificially strong dollar and artificially inflated asset prices in the United States of America. So if we take a look at how many of Japan's assets are the United States, this is my case in point. It's the overwhelming majority. It's not like, well, Jack, you're exaggerating a little bit. Now, I'm not really exaggerating at all. In fact, I might be underselling it. Japan, is de facto backed by U.S. assets. Think about it that way. If Japan has this giant margin collateralized loan that's getting in trouble, well, the collateral is the United States assets, is the U.S. stock market, is the U.S. housing market, et cetera, et cetera, et cetera. So how does this tie to the United States? Well, if Japan starts to repatriate capital back into the country, the U.S. will feel it first. So this is titled, "The Fed is Cutting, but the Market Isn't Listening." The Fed is bringing down rates, which traditionally would bring down the 10-year yields. The 10-year yields are not moving while rates are coming down. Guys, this is unusual. In 2001, we saw Fed funds rate and 10-year yields correlated. In 2007, in 2019, Only in 2024, 25, and now 26 has this pattern changed. Why? Debt. Too much debt. A lack of confidence in the amount of indebtedness and ability to pay it back. Either there has to be inflation, there has to be yield curve control, there has to be something. The bond market is starting to fall apart. And again, remember the bond debt spiral, the debt spiral that we talked about, where if the yields go up, that increases the expense to borrow money, which means you need to borrow more money to pay off that increased expense, which means your debt's increased, which means the yields go up, which means you borrow more money, and it goes on and on and on until it collapses. And we're getting to the point where the US is starting to look a lot like Argentina when you pull up these charts. Okay? So I'm updating my contagion follow the money slide. Okay, step 1, JGB stress, which causes yen volatility, which causes a deleveraging, which causes the US stock market to sell off, which causes the US bond market to sell off, which, like we know, when bonds sell and go down, yields rise, which causes risk off. Okay, that is how Tokyo gets to Wall Street, gets to Bitcoin. Okay, that is how we tie it all together. And when you hear people say Bitcoin's risk off, it's leading the stock market. For those of you that want to understand what exactly that means, well, this is exactly what it means. When the market gets risk off like this, Bitcoin sells off first. And so we've talked about this on this show. Listen, as Bitcoiners, we know it's the best money of all time. We know it is the ultimate hedge against currency decline. We know it is a better version of gold. However, I've talked about this a bunch, and as this tweet shows, this image shows, it's not priced like that yet. Today, Bitcoin is some combination of fiat liquidity plus technology. It's like half gold, half tech stock, okay? So it does often trade like the NASDAQ, like technology. And if you think about it, $1.5 trillion, it's about the size of Tesla. It's just not big enough and not well understood enough by the market to trade like gold. This is why gold has traditionally, and you'll see in a few slides, gold has front-run liquidity, and Bitcoin has responded to the liquidity. This is why their correlation with each other is so low, and they never move at the same time. The market doesn't treat them as a solution to the same problem yet. Us Bitcoiners, we all know where the world is going and that Bitcoin's severely underpriced and misunderstood. But why is it trading the way it is? Why did it fall into the 70,000s? It's because the market's getting a little risk off. Bitcoin is trying to tell us something. It's telling us that the strain in Japan is posing very serious issues to the United States. These countries that are developed are starting to act like developing. And even Scott Bessent issuing a rate check is like, yeah, it's almost time to start printing the money and protecting ourselves. Okay? So the tweet I'm screen sharing here reads, Bitcoin holders have long viewed it as a hedge against currency decline, but this is not a widespread perception among the general investing public, where gold has always been seen as the asset for that and where Bitcoin has been viewed from more than an emerging technology angle. Watch this closely. If Bitcoin starts to react to specific dollar moves and the media and public perception of it as protection starts to spread, it would be very important. So I agree with this. And basically what he is saying is Bitcoin is not treated like gold is today. We're early. If this starts to change during this really crazy time we're living through, just keep an eye out for it. And the next slide I wanted to show you guys is just Arthur posting about his dollar liquidity chart. So he writes, roughly $300 billion fall in dollar liquidity over the past few weeks, driven mostly by a $200 billion rise in the Treasury general account. Government could be raising cash to fund spending in case it shuts down. Bitcoin is falling, not a surprise, given to the fall in dollar liquidity. So again, Bitcoin is an expression of currency debasement. It reacts very sensitively to dollar liquidity, and it isn't yet front-running liquidity because it isn't yet treated like gold. And so, in my opinion, what is happening in the Bitcoin price is markets are getting a little nervous. They're getting a little risk off. They're getting a little panicky because of what's happening in Japan, because of what's happening in America. And when you take into account that Bitcoin is not treated like a safe haven like gold yet, and dollar liquidity is getting hammered, this explains the price action in Bitcoin.
This is how Tokyo connects to Wall Street and how Wall Street connects to Bitcoin. Japan holds trillions of dollars in overseas assets, the majority of them tied directly to the United States. If capital begins flowing back home to stabilize Japan's system, U.S. stocks and bonds feel the pressure first. That pressure pushes yields higher, tightens liquidity, and forces markets into risk-off mode. And in those moments, Bitcoin sells off early, not because its long-term thesis is broken, but because it's still treated as a liquidity-sensitive asset rather than a full monetary hedge. Jack is clear on this point. Bitcoin today sits in an awkward middle ground. It's part monetary asset, part technology trade. It reacts sharply to changes in dollar liquidity, treasury issuance, and bond market stress. Gold tends to front-run liquidity cycles. Bitcoin responds to them. For now. That's why declines during periods of tightening don't invalidate the thesis. They confirm Bitcoin's sensitivity to the system it's ultimately designed to replace. And this is where the bigger picture comes into focus. Despite all the stress, cracks, and volatility, macro conditions are beginning to shift. Today's ISM reading came in at 52.6%, the highest level in over 40 months, signaling that U.S. manufacturing has re-entered expansion. Historically, major altcoin cycles didn't begin until ISM moved decisively higher, above 55% in both 2017 and 2021. We're not there yet. But this is the first real sign that the macro headwinds suppressing risk assets and alt season may be starting to ease. This is how it begins. Not with euphoria, but with stabilization. Liquidity doesn't turn overnight. Confidence rebuilds slowly. And while volatility may get worse before it gets better, the structural forces Jack outlines suggest we're not watching the end of the system. We're watching the transition into the next one. If you found this analysis valuable, smash the like button, subscribe for more high-signal macro and Bitcoin insights, and drop a comment below with your thoughts. Do you think Bitcoin starts behaving more like gold in the next cycle, or does liquidity still rule the short term? Thanks for watching, and we'll see you in the next one.